Hello, I'm Martin Pring, and welcome to this mid-year outlook. We've got some really interesting stuff to cover today, so let me just quickly summarize it for you. First thing we're going to take a look at is economically where we've been, where we are, and where we might be headed. Now, I think the primary trend for the US equities is bullish, but I'm keeping a very close eye on the secular or very long-term indicators for some possible problems. I don't think they're going to be triggered because the evidence in favor of the primary trend is very strong, but I think it's something we need to keep our eye open for. We need to be prepared for a likely signal as the year progresses of higher commodity prices and a shift to inflation hedge assets once the current commodity short-term correction is over. And the dollar seems to me to be rolling over. It's below its 12-month moving average and its long-term momentum, the KST, has gone negative. And by the same token, our last chart talks about gold, and gold looks strong. So this chart here features the Chemical Activity Barometer. It's a leading indicator put out by the American Chemistry Council, and it's led pretty well every recession since the 1920s. The red highlights in the chart represent recessions. The beige ones represent slowdown. Now, slowdown and a recession differ. That example just there in 2005, 2006 is an example of a slowdown where the growth path of the economy comes down, but it doesn't really seriously get and consistently stay below zero. On the other hand, a recession is when things actually contract. And you can see that the price oscillator there in both situations goes below zero or had gone below zero before the recession started. So come January, I should backtrack there a little bit and say that since the recession in 2008, 2009, we've had three slowdowns, one in 2011, 2012, one in 2015, 16, and one in 2018, 2019. And these slowdowns are really helpful because they help to prolong the recovery by allowing the economy to kind of get a pit stop before it moves on to further gains, as opposed to getting overheated, in which case the recovery is likely to be aborted fairly soon. But if we go back to January, you can see that the indicator was at an all-time high. And it looked, if you look at the growth path in the bottom panel here, as if we're often running again for another recovery phase as part of this overall recovery since 2009. But of course, we all know what happened. The economy collapsed, and we went into a tailspin. And now we're trying to get out of that again. So let's just take a look at the next slide, which compares the S&P Composite, because we're really interested in buying stocks rather than the economy so much. Only interested in the economy in the sense that 90% of the time or so, the stock market discounts developments in the economy. So that's why it's important to keep an eye on the economy. So this chart here includes in the bottom window my master economic indicator, and it fluctuates up and down, but it comes into its own during a recessionary period when you can see it really starts to collapse quite a bit. And that obviously tells us we're in a recessionary phase when that happens. And once again, the red highlights represent recessions, of course. So the idea is that with the benefit of hindsight, we can see where these inflection points are on the chart. But in real time, we have to kind of have some measure of when that recession is over. And the measure I use is for the indicator to move back above this green trend line, as it's done on these three different occasions. And each time it indicated the end of this red highlighted area, which is, of course, recession. Same thing over here. And not quite at the end there in 1982, but again, a very timely signal for stocks. And then we have three other indicators, three other signals here. And one of them in 2001 was one of the few occasions when the stock market became unhinged from the economy, because the indicator correctly rallied back above the green line, and you can see it's rising here, indicating an improving economy. But the stock market never managed to get above its 12-month moving average and didn't respond. 99 times out of 100, it's going to respond. So now we have the current situation, and here you can see that the indicator has indeed started to perk up. It's got a long way to go before we get to the green line, but it does look as if downside momentum in the economy has dissipated, and we saw that in the previous chart as well. So that makes me pretty bullish. So it's in the process of reversing now. And then finally, on the economic scene, we have real retail sales. And this chart, by the way, if you want to know what the dates, you can't see the dates in the bottom of the charts. You can always look up at the top in the legend, and it always tells you where this chart starts off and where it ends. So the retail sales, again, showing the red highlights as recession. The retail sales broke a very important trend line, going all the way back to 1960 or so, at the end of the last recession. And although the retail sales continue to, real retail sales, I should say, continue to advance, they were never able to get above this trend line again. And what's happened since, of course, is that the economy has crashed, and we've now got a very decisive penetration of that trend line. And that suggests to me that momentum is long-term, very long-term momentum in the economy has dissipated. And that's what you can see from the bottom series here, which is a long-term momentum indicator, 41-month rate of change or so. You can see that each time it reaches a peak, it's a lower peak. And we've had a few periods in the past when there's been some transitional things going on, like in the mid-1940s, where the economy basically went up and down in a flat beta, trading a range-bound manner as the stock market did. And that was a transition from World War II to the post-war peace. Then we saw a trend line break in retail sales in 1982. This is the 82 recession. And that signaled a loss of upside momentum. And that was followed by another recession, a double dip, the only post-war double dip that we have into 1981 and 1982. And that proved to be a transition from inflation to deflation. Now, with commodity prices being very, very low and having been in a bear market, secular bear market for bonds since 1981, it seems to me there's a possibility we might be in another transition period where we move from deflation to inflation. Alternatively, you could look at overcapacity in some major industries like the energy industry, or you could take ideas that the pandemic has kind of accelerated the trend towards remote traveling, remote learning, and remote working. And that structural change is going to require the economy on a long-term basis to undergo a lot of rebalancing and so forth. We just don't know, but that's suggested to me by this very long-term trend line break. But we're here to focus on the stock market now. So here's an inflation-adjusted S&P Composite. I always think it's important to have inflation-adjusted because if you buy a stock, for $10 today and the CPI doubles and the stock stays at $10, you've lost 50% of your money and so forth. Underneath is a Shiller price-earnings ratio, and I look upon this price-earnings ratio more as a indication of psychology, otherwise than of fundamentals. Otherwise, why would people be willing to pay $30 to $35 for a dollar's worth of earnings in 1929? Yet in 1932, it was down to $6 or $7. It's a change in psychology. So when they're willing to pay a very high amount for a dollar's worth of earnings, it indicates that investors are very confident. Well, if you look at the chart over the long period, you can see that these four arrows kind of indicate when we had a secular peak in inflation-adjusted stocks. And if you look carefully, you'll see that in 2017, beginning of 2018, the indicator was back up to that same level again, suggesting that in terms of psychology, it was at a dangerous level. It's since corrected and went below its 96-month moving average, which is what this red highlight means. And it moved back above the average. So now it's in a kind of a neutral trend. And if my expectations for the primary trend to be are positive, that should mean that this indicator will continue to move up. Because I think trend over the short term being two to 3 years, is actually more important than the level. The level only becomes important when you can see people have got to be too optimistic, and that means they've made a lot of careless mistakes that then get unwound during the next bear market. So that's kind of neutral at the present time. It was bearish because it was below its moving average. Now it's neutral. Next chart shows again inflation adjusted S&P, and again we're looking at the secular trend. And underneath is the S&P divided by M2. Now the idea behind this chart is that when the Fed throws money into the system during a recession, the stock market smells that out and it goes up on a real basis, and the ratio of the S&P to the M2 also goes up. So M2 is expanding, but S&P is expanding faster. And you see that all the way through here, that the ratio, when it bottoms out, agrees with what the stock market is doing. So the other thing on the chart here is there are periods when we're in a basic secular downtrend, and I define that as being below the 96-month moving average, this thing here. And that I've shaded into pink, and you can see that most of the time when we're in a secular bear market, we get a zigzag down in the primary trends for the stock market. When we're in a primary bull market, the reverse happens. Notwithstanding a nasty crash in 1987, just here, most of these bear markets are relatively contained. You can see that since 2009, that all the bears that we've had been relatively contained. So earlier this year, the S&P M2 ratio broke below this trend line, and it temporarily broke below the 96-month moving average, indicating that maybe a secular bear was on the way. But I think there's time for this thing to clear itself up. But one of the things is that in the S&P, we saw a large bounce off the low, almost back to the high, and yet this indicator here was barely able to budge at all because we had a record increase in M2. And that should have been very, very bullish for the stock market, more bullish than it has been. But it seems to me that the people in the stock market may be questioning the ability of the Fed to get things going through money expansion of money supply alone. So it's at a critical point just here from a secular point of view. And also this rate of change here, the 48-month rate of change, is just a little bit above zero. And once that goes below zero, that tends to be, again, a negative signal for the secular trend. And our final secular signal comes from the relationship between stocks and gold. The idea is that when stocks are outperforming gold, it means the economy is doing well and people aren't concerned. When gold starts to outperform stocks, it means that people are worried about the economy or worried about the currency or worried about something, and it's not such a good idea. So these pink areas represent the periods when the ratio has been below this red dashed line, which is the 48-month moving average. And you can see that most of the time it's below its 48-month moving average. The S&P, inflation adjusted, is moving down. There's a couple of exceptions in 1975 and the early 2000s. But by and large, when it's below the moving average, that's acting as an amber or red flag for the secular trend of the stock market. So now we're looking at the current situation. You can see that a year ago, the ratio broke below this uptrend line. And now it's below its 48-month moving average fairly decisively. And so we'd put another pink shading in there. And you can see also that the long-term momentum, the KST, is also in a bearish mode. So this one needs a little bit of watching. Unlike the other series, we don't have as much history to go on in terms of all the secular trends, but it's something I'm watching very carefully. I don't think it's going to be triggered, any of these signals. Obviously, this one here has, but I don't think in any serious way, because as I mentioned before, I'm fairly positive on the primary trend. One of the reasons is I've got this indicator here. It's a 12-month rate of change. And when it drops, or a model, I should say, when it drops below this line here, it's minus 5%, and then rallies back above zero, it gives us a buy signal. So here we are, goes below minus 5, crosses back above zero, and there are all those signals. Since 1953, we've had 22 signals, only one failure, that was in 1957, and the average gain based on a one-year holding period from when the signal took place has been 15%. So that's a very consistent indicator, which gives me a lot of confidence, as long as it remains above the minus 5% level, of course, that it's very positive for equities. I found this headline in Bloomberg the other day. No one can agree on where the stock market will be in 6 months. I thought to myself, I'm not sure myself where it's going to be in 6 months. I think it's going to be a positive environment. And I think it's going to be a more inflationary environment favoring inflation-sensitive assets. But I don't know where it's going to be, and I can't really judge what the intermediate trends are likely to be unless I get into a specific situation where I can see what the indicators are doing and so forth. So on the basis of that, and on the basis of some of these other indicators, what I'm going to do here is not focus on the intermediate trend so much, but focus more on the idea that why the intermediate and the short-term trends don't really matter in the long run. So let's take a look at one of these indicators. First one is a 12-month rate of change, and the 10 there means it's a 10-day moving average. So it's a 10-day moving average of a 12-day rate of change. That's what the red line is. And at the beginning of a bull market, you often get really, really strong momentum. Where some of these momentum indicators can make multi-year highs. Now, usually when you get into a situation like that, where they're very overbought, that tells you that the probabilities favor a decline. But when they come at the beginning of a bull market and they're exceptionally strong, you need to pay attention, because that's kind of like a real thrust that coming off the bottom that suggests prices are going higher for an extended period. So let's just take a look at some of those examples there, where the indicator went above the blue line and then rolled back below it. Same thing here. Same thing here in 1974, 1982, and then the last big bear market in 2009. And of course, we're seeing it. And you see what happens is markets just continue to go up for a considerable period of time. Remember, this goes back to 1922, so it doesn't look much on the chart, but in real time, it certainly is. Oh, I should point out there's a couple of failed signals here in the mid to late 1930s. They went up for a few months, but I'm looking for a signal where it goes up for a much more extended period. And so we've got one of these signals that took place about a month ago. And that suggests to me that we don't need to be looking down, we may need to be looking up, because when you get these signals, it tends to mean that the market's going to be going up for an extended period. So another reason why I'm kind of bullish here is the VIX. This is a monthly chart, and the VIX, of course, is the indicator that measures fear. And what I've done is I've highlighted with arrows those periods when the VIX is at or above its overstretched line at around 35. And that, of course, lines up quite nicely with a bottom. Sometimes it's a little early like this, and here, sometimes it's sort of dead on. But the point I'm trying to make here is that if that's a bottom and you've got maximum fear, then as the rally takes place, we should see a dissipation of fear. We see a dissipation of fear in the indicator as it comes down to a lower level. And as it's coming down, so prices are going up. So fast forward to the current situation, and here you can see that the VIX peaked out and got a little bit of a rally, but not anything. I mean, it is a big rally, of course, off the lows, almost back to the highs, but nothing like these rallies that we've seen from similar readings in the VIX. And it's still at a high level. So there's still a lot of unwinding of that fear to come before we reach the kind of level that this indicator will be signaling some problems for. So now we're going to take a look at some inter-asset relationships, because I really enjoy these because they kind of tell you about what's going on. Some people might know these intermarket relationships. They're a form of intermarket relationship. But here's the S&P up in the top window. And underneath is the ratio between stocks and bonds, or rather it's the KST of the ratio, the momentum of the ratio. So when we come into a recession, initially what happens is the Fed eases things, credit demands fall, so interest rates peak, and the price of interest rates peak, and that means that bond prices bottom. So the first thing that happens is that bonds are going up, and stocks are still discounting the economy, so they're coming down. But then after a while, people in the stock market begin to anticipate that the stock market, the lower bond yields, higher bond prices are going to stimulate the economy. So at some point, there's a turn where bonds were favored over stocks, and now stocks are favored over bonds. We can look at the raw data, but I think a much more instructive way is to look at this KST. So these inflection points are monitored when the indicator, the KST, hits its low, crosses its moving average. And you can see we got 11 signals here, one of which I count this as a failure here because it didn't really rise very much. But in most of these situations, you've got a very nice rally in the stock market taking place when this ratio bottoms out, or this KST bottoms out. Right now, you can see that's in a bearish trend. So it hasn't yet triggered a bullish signal, and maybe it won't for a while. But I think this next chart suggests strongly to me that it is soon going to experience a buy signal by turning to the upside. And that's this chart here where the S&P is compared to a 13-week rate of change of that stock bond ratio. And we're working on the same principle we were working on for the 10-day moving average of the 12-day rate of change and the VIX. And that is when you get to a high level, usually that indicates there's a lot more of the bull market to come. So there you can see the oscillator reach a very high level in reverse. And we see there really wasn't much in the way of a correct. I guess that one there was quite nasty at the time. But basically, it was a long-term uptrend once that had been signaled, which was another indication of fear as well. So look at the current situation on this, showing the rallies that followed. Now look at the current situation, and you can see that it's just gone bullish, and it's now reversed from its high reading. So again, that suggests to me that this ratio is signaling with its very, very strong and vibrant bullish signal that prices are going much higher. So now we look at the inflation-deflation relationship. And here's the CRB Composite. And we look at a couple of intermarket relationships that help us identify whether commodities are going to go up or down. First one is my inflation-deflation ratio, which you can plot on StockCharts with the symbols exclamation mark, PRII, exclamation mark, PRDI, and there's a colon in between. And the PRII is an index made up of inflation-sensitive stocks like resource areas, and the DI, the deflation index, is made up of defensive stocks. And when it's rising, it's inflationary. When it's falling, it's deflationary, because it means that the deflation-sensitive stocks are outperforming their inflation-sensitive counterparts. We're just taking a broad look at this, and you can see that the two series, the CRB Composite commodity prices, move up and down fairly closely what the stock market's voting for, either inflation or deflation sensitive stocks. The other thing to note about the ratio is it has a tendency to lead or coincide with the CRB Composite itself. And sometimes you can get a clue as to that's going to happen by drawing some trend lines on both these series, and when the trend lines are violated, you get some signals. So right now it's broken above this trend line here. And the other thing is the KST for the ratio is also bullish. So let's get rid of this stuff and put some arrows in at the low part of the KST when it starts to turn to the upside. And you can see that in eight times since 1991, this indicator with the KST has given us a buy signal. And each time we've had a rally in commodity prices. Sometimes they're huge like this one, and sometimes they're relatively small. But even that lasted six or 8 months or so. So that's not too bad. I mentioned I was going to look at, and as I mentioned before, we got a KST buy signal there. I mentioned before that we were going to look at a couple of different intermarket relations or inter-asset relationships. So the commodity bond ratio is the best measure I know of for determining whether we're in an inflationary or a deflationary environment. When it's going up, it indicates an inflationary environment. When it's coming down, a deflationary one. So here's the KST of the CRB to the US stock bond, commodity bond, CRB to the USB, the 30-year bond price. And once again, we put once again, it's a KST, of course, and we put in the arrows, and each time we find that we get a rally in the commodity bond ratio. In other words, if you want to figure out whether the market's going to be oriented towards inflation or deflation sensitive stocks, you look at the direction of the KST on this stock bond ratio. And at this point here, it was turning up. And then later on over here, it was turning down. I didn't put the sell signals in. But the other thing is it's still going down. So we're still in a deflationary environment favoring bonds. But it's obviously very overextended here and could turn at any moment. But it's not there yet, so it hasn't given us a signal. So we can apply this to the 30-year bonds as well. So here's the ratio between the bonds this time and the CRB. So now we're looking at deflation to inflation. So when it's going up, it's bullish for bonds, and when it's coming down, it's bearish for bonds. And what I can do is, again, look at this KST of the bond commodity ratio. And you can see that the vast majority of these were followed by a rally in the bond market, in the 30-year bond price. Now, you may be saying, well, that's pretty easy because it's basically an uptrend. So it's pretty, you're probably going to catch these moves fairly luckily because the basic trend is up. But I can show you the sell signals, which are going contra trend to this uptrend. And you can see they too giving us pretty good signals, apart from this one here, of weakness, potential weakness in the bond market. And once again, as we saw before on the previous ratio, it was down at it towards the lower end. This is now up towards the higher end. What that tells me is that this bull market in bonds is very, very mature. And what I can continue to go up a little bit more, perhaps, it's like the next big move is more likely to be down than up in terms of prices. So now we're switching this around for commodities, and we're looking at the commodity bond ratio as opposed to the bond commodity ratio. I put in the buy signals again. There were 10 signals, and one of them was a losing signal. Well, it wasn't losing, it just didn't experience much of a rally. And again, if we're looking for a bottom, we're close to an oversold situation. We have to wait and be patient for this indicator to turn. But if we're looking at the second half of 2020, I should say, there's a good chance that it's going to turn within that time period. One other ratio I'd like to talk about is the S&P versus the rest of the world, the SPY versus the EVU. It's been in a strong uptrend for the S&P because it's above its 65-week exponential, and it's also above this trend line. But by the same token, and also the KST is positive, but by the same token, the short and the intermediate are coming down. So that may threaten the integrity of this trend line. We just have to wait and see. If the line is broken, one of the areas I would look at would be China. And here's the China A shares, the ASHR. And that's in the top window. Its long-term KST is in the second window. This is relative to the world in the third window. And then the KST of this relative chart is down there. So if we draw in some trend lines, you can see as of Friday, last Friday, it is right at that trend line. And also the relative strength is also broken out. And you can see that both series have a rising KST. So I think that's an area to watch. China is an area to watch very, very closely indeed for some possible breakouts. And some of the Chinese ETFs have already done so. So a final chart here that compares gold to my gold model. What the gold model is it compares the 6 to the 15-month exponential moving average. So when the 6-month exponential is above the 15, we have a rising series. And when it's below, we have a reason. I'm sorry, we don't have a rising, it's above 0. And when it goes below 0, that's bearish. That's what these indications are. I like it because there haven't been many whipsaws. There's one there, and a buy signal whipsaw there. So the other thing I like about it is when we get the sell signal, prices usually haven't gone down by very much. And if you look at the current situation, it's been a very consistent indicator since the 1970s. The oscillator is still rising, and that's very, very positive because it's going to take a long time for it to go into negative territory. Well, that completes what I have to say. I was trying to get it into 20 to 30 minutes, and I think I just succeeded. Thank you all for tuning in. Good luck and good charting.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.